Welcome to the Nexus Point. We are Rich Romero and Geoff Bruskin, and this is the podcast for next generation accounting firms. All right, welcome back to the Nexus Point podcast. As always, my name is Rich. We're here with White Tiger Connections managing partner and CEO Geoff Bruskin. Geoff, how you doing today?
I'm doing great, Rich. How about you, man?
I'm doing all right. Another week has flown by. We're staying busy and things are good. So can't ever complain about those things. So I'm good. We're going to jump right into it today, and we're going to, again, look into the future a little bit, kind of talking about the next decade of things that we kind of see happening because, just kind of jumping off of our podcast last week where we talked about the Nexus Point itself. The professional services industry, financial services industry is heading towards a big decade of consolidation, tech disruption, and talent scarcity. And, some of those firms are going to start adapting and thriving where others may start to get squeezed, and the future might not look too great for them. So this week, we're going to kind of jump into, the predator versus prey mindset, and building towards being a player in the market in the next decade or having to sell. So my first question to you off of that topic is, what are the major forces that will shape the financial and professional services professions heading into the 2030s?
So, goodness, that's a big question. The major forces that will shape the market in the next decade. Number one is talent. Talent, whether you run a financial services firm, whether you run a CPA firm, whether you run a law firm, whether you run an insurance agency, anything in the realm of professional services, your talent is going to set the tone for the next decade. And specifically what I mean by that is the talent who is extremely high aptitude from a compliance standpoint, extremely high aptitude from a relationship management standpoint with clients and advisory standpoint, that is, and also high aptitude on leadership. And that leadership includes the ability to work intelligently with AI and work intelligently with technology and designing systems where technology and the human capital under your leaders are working synergistically with one another. So that's the big bucket of talent. Number two, I would say, is technology. And I actually think talent and technology, as I said, I think they go super hand in hand because ultimately tech is going to replace only the people who are the tasks. Your job is the task, it's going to replace you. But if your job is the management of tasks, technology will always, at least within my line of sight, be a tool that the most competent people in your business are using. So talent, tech, and M&A. And M&A being both vertical consolidation as well as horizontal consolidation. Vertical is obviously like acquiring like, and horizontal is a tax business acquiring a wealth management business, a law firm acquiring a CPA firm, and on. Kind of the platformization is the horizontal aspect of M&A. And so those three things I see defining the next 5 years and setting the table for the following decade.
Yeah. And I know we've touched a lot about each of those specific subjects. So I'm glad, that we're staying on theme consistently here on this podcast. And we're really trying to, hit home on those three major subjects there. And I mentioned, the predator versus prey mindset, but I want to know, what does that mean in your eyes? Like, for a firm to be a predator versus it being prey in this landscape that we're heading towards and that we're in, quite frankly.
So I use, Rich, the predator-prey analogy to describe the firms really, today, 2026, Q1, and I think this will continue to be true for at least the next 12 to 18 months. Firms have a choice. You can think about, do you want to build towards an exit in the next 2 to 5 years? Or do you want to build towards being a player in year 6 to 16, right, in the next decade? And so if you're thinking about actually building infrastructure to then run something larger yourself, and you have at least, say, a 15-year aperture, which many folks our age, I'm in my mid-30s, you're in your late 20s, should absolutely be thinking about, what the time period between being, 35 and 50 is going to be like. But even the folks who are, let's say, 45 today might want to work until they're 60, or they might be interested in retiring in the next 5 years. Obviously, there are many folks who we talk to regularly who are already in their late 50s or 60s, and they're obviously more aligned towards a 2 to 5 year sort of exit, although many of those folks have internal succession, either children in the business or next generation leaders. And so kind of the whole player mindset, the predator mindset, where you're now thinking about gobbling up other firms, being the buyer in an M&A capacity, being the strategic architect for what the 2030s will look like for your firm. it's good to identify that now. Even if, like I said, you have that internal succession already within your firm, you can kind of mentor them into the CEO position as you're getting prepared to exit, or take some chips off the table, say with a minority investment, blah, blah, blah. There's a lot of different vehicles that are available to you. But the predator prey, right? Prey is really, okay, 2 to 5 years, my exit window. I'm going to exit before the decade finishes out, the 2020s. And it's obviously a phenomenal time to do that. There's never been a better time from a multiplier perspective, Q1 of 2026, than what the financial services industry is doing, what the CPA industry is doing. And now the law firm industry has we've broken ground, and the emergence of the MSO, the managed service organization, has made that kind of fractional family office capability now possible inside of the platform professional services environment for a private equity or a wealth manager or a CPA firm to now own the entire locus of delivery. So really, there's just incredible opportunity from an exit, a transition, a buying capability now. And I think that what we like to encourage is that firm owners just get honest with themselves about, what is it that you really want. If you're looking within the next 2 to 5 window, that makes the conversation that we would have with a firm owner much more one-dimensional, which is actually a great thing, because now we can explore options in a much more contained window. And it's exciting because we can maneuver within that contained window. On the other hand, if you've got, if you're not really sure of what you want to be when you grow up, that's okay. But the sooner you decide if you are in this to play, or if you are in this to, ultimately exit, but have some kind of maximized exit, the sooner that, someone like me, someone like Rich, someone like, whoever your chosen advisor is, can counsel you on how to achieve the best possible outcome inside of that known framework.
Yeah, and the last point that you kind of just touched on there, we hopefully, if we have time today, and I think we will, maybe we can touch on how firms can potentially do both. They can build to play, and then eventually later in that time frame, like you were mentioning, lead to that exit or that sell of their firm that they've built to be, quite large. But speaking of predators specifically, I feel like, we've had conversations with some large firms that they know very well that they're doing some things well. Their financials are telling them that they have good client service. They're doing a lot of really good things. They're comfortable with where they are. Does that automatically make you a predator? Or what are the slight differences between being big and then being able to be called a predator in the market?
Yeah, that's such a great question. I think, the predator prey analogy isn't a perfect one, because there's something, aggressive about that. And I think you have to be aggressive in order to buy a business. But I think, to your point, there's actually something beneficial to setting up the infrastructure internally, so that firms that are looking to be acquired out in the market are actually drawn to you. So instead of you needing to go out and actively gobble these firms up, you still need to make yourself known, but you don't necessarily need to compete on price as heavily. You don't need to try as hard to stand out when there are structures contained within your firm that make it more appetizing. And probably the best example of that that we're seeing right now is in the world of financial services, specifically asset managers who have an integrated tax vehicle. Not only tax advisory, but very profoundly tax preparation, tax compliance, the ability to represent clients before the IRS. Kind of that entire tax vehicle is extremely attractive to a $500 million asset manager. Say it's 4 guys who are looking to join with another wealth management firm, but they don't just want to join with anybody. They want to join with someone that has already addressed this very specific pain point that their clients are experiencing. And so they're selling. They don't need to build the function internally. They don't need to acquire a CPA firm. They don't need to hire a tax manager and build all those workflows. They're already looking to sell. And so they're going to be drawn to someone who actually has that capability already. So then they're getting the exit they want, but they're actually bringing their clients narratively now into an even better situation. It's not just hot air. Oh, this is going to be a better culture and we're going to hand you off to someone. No, it's actually something that's tangible that can be narratively offered to clients. So this is something that we see a lot of success with financial services firms building this tax vehicle because they want to do acquisitions, because they want to make themselves more attractive. And the same is true in the world of accounting. A lot of accounting firms, tax firms specifically, don't have any kind of wealth management vehicle. And a $4 or a $10 million firm that specializes in high net worth clients, there's a lot of latent assets in those firms. And if you're a $20 million CPA firm and you have an internal RIA and you have the workflow set up, the kind of referral structure set up, the sharing of revenue and enterprise value in a rolled equity capacity with maybe some of that second generation talent that is reticent to sell. Maybe the equity partners want to sell, but the income partners do not. Well, if the income partners get to now become equity partners in a larger firm that has a more distributed client service capability, there's more that can be offered to the clients, and their pro forma from a compensation perspective can also be more robust. So the horizontal capability, Rich, I really do believe has a lot of impact on the gravity that buyers, again, thinking about predator versus prey, understanding what you want to be when you grow up. Where am I going to be in, from 2030 to 2040? If you know that you're going to be playing ball in that decade, the sooner that you build this comprehensive vehicle and do it the right way. I'm not suggesting that you half-ask it, but when you build it the correct way, it is going to help you better achieve all of the other ambitions that you have: organic growth, deeper organic growth in your nuclear category. So if you know you're going to be doing that, the sooner that you get on the bandwagon and start to build this, one-stop shop sort of environment for your clients, it's going to benefit your business strategy, your clients. It's silly not to do it.
Yeah, and to take it back to like those first 2 points that you answered in my very first question, going back to the technology and the talent, how will those things kind of separate like the really durable firms from the ones that maybe are, like I said earlier, they may get squeezed or left behind, maybe isn't the best way to put it, but they're going to kind of like face a situation where they're unsure, they're unclear, and they have to make kind of a more quick decision as opposed to being in control of their future. So
yeah, it's a fantastic question. And so I'd say that the talent that we as a firm, White Tiger Connections, we believe that the future of talent and professional services is fully remote. This is profoundly necessary in the public accounting profession specifically because the AICPA has not incentivized young people for decades to come into the profession. We now have the baby boomer exodus from the profession. We already have a hollow middle in the profession. And so early, medium, and late stage career folks, we're being hit from every angle. But the talent crisis does not exist in accounting. Once you unlever geography and you go to the entire market, we find the best quality candidates. And that's not just us. There are fantastic quality candidates on a remote basis. But you have to have the technology, the firm platform to enable those very high quality people to be successful on a remote basis. And so just from a talent perspective, there is more demand for financial services, CPA services, and estate-related services, both, all of these kind of multifamily office services, than there are professionals who can do this work. That's a true statement. There is even more demand for an integrated experience that does all of these things for clients. And so knowing that talent is going to be something that you bump up against when you are developing capacity, the earlier that you address this with a remote talent acquisition thesis in your corporate body, the better you will be able to meet the demands of scale because you will not have to fight with the local talent pool in any area where you have a brick and mortar. And so I'd say the remote talent thesis, Rich, if you're not planning on selling within the next 2 to 5 years, just like expanding your functional area, I think this is something that firms are silly not to adopt and embrace. Doesn't mean you have to stop hiring locally, but you should absolutely look for even better candidates on a remote basis, right? Have more scrutiny of those folks, but that's okay because you will find them. There are fantastic folks all over the country who are disillusioned with whatever the local opportunities that they have are, but they're exceptional talents. So that's how I would say talent comes in if you're thinking about being a player in the next decade. And then on the technology side, already alluded to it a little bit, Rich, as far as you need to have a project management system, a delivery system, as much billing automation as possible, as much CRM automation, go-to-market automation, every part of your business, your human capital management. The more sophisticated technology you have, the more equipped you'll be to run a distributed firm, a remote firm, a multifunctional firm, a high quality client experience firm. And what gets really exciting, Rich, is what the technology is going to do in the next decade. We haven't even fathomed yet the kind of AI products that are going to be coming out 2 years from now, let alone 6 years from now. But I think the point is that the better that a firm is modernized now, the more equipped that firm will be to take advantage of the net new tools, which will continue coming out and have more and more functionality that we haven't even dreamed of yet for our clients. Whereas the further in a stone age the firm is, there's just going to be more pain to ultimately make that transition. There's going to be less liquidity if a firm does decide to exit, things like that.
Yeah, and that's those are all really great points. And I mean, I know we've had several conversations with clients and people who are trying to figure this out. And once we really kind of lay that foundation out for them, they really start to open their minds up, and they realize that this is like the future isn't going to wait for anybody. And like a lot of the time too, they have a lot of this infrastructure in place. They just don't know how to like capitalize on it. And we've touched on that a little bit too. And that's why we always go back to work finding someone who you feel like you can trust and is going to give you the honest feedback to continue to maximize all the capabilities that you have within it. On the flip side of that, is there any risk for a firm to like just keep going about the status quo, be in like a stasis state where they're not really putting too much pressure on themselves, or things like that? Like, what is the market going to do to them? Like, what challenges may they face if they're like, I don't want to even think about trying to do the other side of this?
That's a good question. I don't think there's a ton of risk if you're planning on selling within the next 2 to 5 years that you're going to become obsolete in the next 2 to 5 years. I think the risk, if you're going to be selling in the next 2 to 5 years and you don't embrace a change management oriented thesis when we talk about all of the different things that are happening in the market now, because by the way, if you're planning to sell in 5 years, you could still execute an entire M&A thesis. There are private equity firms that have 5-year theses and that acquire 50 firms in that timeline. So I just want to be clear, but if you know that 5 years is the goal, right, back to the earlier conversation, the sooner that we talk about that very openly, that those are the contained boundaries of the thesis, the more honest and kind of direct we can be in helping to frame what's actually possible, what the barriers to entry are, things like that. So that's the importance of clarity. But I don't think there's risk, Rich, of like you becoming obsolete. Like a lot of folks talk about that. If you're a wealth manager, if you're a tax preparer, if you're a tax advisor, if you're an estate planning attorney, if you're an accountant, right? If you're an insurance agent, anything within the realm of professional services, if you keep doing what you're doing, the way you're doing it right now, you might lose some clients, maybe, maybe not, honestly, in the next 5 years. I think that the market is a little slower to adopt than that in terms of like you becoming obsolete, you're irrelevant. I think where you're going to feel the pain is on your exit. So if you are exiting in 3 or 4 or 5 years, for an example, and you don't, when you're selling a house, what do you do to it? You might get a new floor, you might get a new deck, you might get a new front door, you might get a new roof, you might paint that room, which has, paint falling off the wall. So the kind of getting your firm into a more attractive state for a buyer to buy it is going to have massive arbitrage for you on the valuation side and hopefully the deal structure side too, where you're getting more cash up front and there's less risk, back to your earlier comment, of something like an earnout or anything which is conditional upon something that you don't have control over, like what the buyer does with your business. And so doing the hard work of some of this change management now, like I said, I don't agree with all the naysayers that are going to tell you that you're not going to be relevant in 24 months if you don't get an AI program to do X or Y, but you are going to feel that pain when it comes time to exit. And at some point, eventually, you probably do want to exit, or even hand the business down to someone, younger than you, in your family or in your sphere, and hopefully you want them to have a better life than you. And so I think it's, for 99.9% of cases, you should think seriously about change management to adopt better technology, better talent acquisition strategies, and at least an awareness of M&A dynamics and functionally expansive dynamics which are taking place in the market.
No, that's helpful information too, because I think, it's just like, I feel like it's always one side of the coin. Either you have to do one or you have to do another. And I think it's always helpful to kind of hear, that things aren't going to be horrible if you don't do the opposite side of whatever it is that we're talking about right now. So I'm glad that you kind of threw that out there, but you also still touched on a point where, the exit is often an event that is a big one for many firm owners and things like that. So it's important for them to kind of understand that dynamic, that like, while doing nothing now, they're still going to have a really strong business. They're going to keep doing things that have set them up for the success that they've had. Maybe they've run a 20-year firm or things like that, but on the back end, that's where they maybe feel it the most. But the last thing I just want to talk about too, you mentioned the M&A portion of this whole conversation, and we focused a lot on like the players. We'll avoid calling them the predators again, but the players in the market. So that's a big portion of this. So how does that go into them eventually having that liquidity event way down the line when you talk about that further horizon down the line. So that way they can really kind of build something massive, because we've had conversations and there's folks out there who are thinking this way, and I know there's a few that pop up in your mind, but I just want to understand that aspect of it, and then we'll close things out here, because I think it's an important part of, you're going to build something so massive, and then what does it look like down the line for you, and how does it all kind of interconnect?
I love the question because there's so much conversation of like, where does this crazy private equity train end? Like at some point, it's going to crash into the wall. Multiples are going crazy. Like the bubble's going to pop at some point. And I actually don't think it's going to. I think it could, just to be totally clear, a global pandemic, a nuclear war, right? I mean, there's horrible things that could happen and anything is possible. But I always try to think about playing the winning hand. One of my mentors early in my career told me to do that. And I think that's a good way to live your life and to build your business and to play. You can play the winning hand conservatively, but you should play the winning hand. And so what does that mean? Where do I think this whole thing is going, Rich? I think it's going to rise. And so, how can that be? The answer is technology. So if you look at what Facebook is trading at, I don't know what it is, this week, and maybe Facebook isn't the perfect example, but Microsoft or Nvidia or Tesla, the companies that are the most valued companies in the world are, of course, technology companies. And we are now seeing the technologification of all industries. I mean, for crying out loud, we've got robots doing martial arts in China. That was the big video that I was watching on TikTok this week. And, all kinds of robotics. No industry is safe. Medicine is not safe. Professional services isn't safe. Food service isn't safe. Nothing is safe. The tech is coming for everything. For business owners, I think this is a good thing. And the reason for that is 5 years from now, 7 years from now, 9 years from now, what is professional services? It's technology. And so I think that this moment that, this singularity that everyone talks about, what is this moment in business where all of these multiples are rushing upwards, and the aperture between, the highest valued multipliers in the country, which, Facebook is, 27 or 30, something like that, times its earnings. Right? And you've got wealth management firms trading for 21, 22 times, CPA and accounting firms trading in some cases for 15 to 18 times. Eventually, where does it go? Everything becomes valued kind of in a similar context. I would argue actually that professional services has something distinct that technology does not have, and that is trust. Technology companies do not have the trust of their consumers. They might have the habit building capabilities of their consumers, but they do not have advisory level trust and know-how. Maybe the LLMs get there in some period of time, but I think, at least in my line of sight, the advisors who are subject matter experts who use the technology to better inform the specific situations that their clients have are equipped maybe to exceed technology multiples, because if the firm that is offering the advice is run on the same technology platform that the tech companies run on, that they are, I start to get excited about what the possibilities are. I think it could actually exceed. At the very least, I think there is some kind of blending, some kind of ballpark which is coming because of what technology is doing. And like I said, all markets, but professional services specifically is one I think we should watch, and I think is going to continue to perform very aggressively, like I said, barring any kind of, insane
Yeah, and
circumstances.
I mean, I would agree 1000%. And your knowledge expands way further than mine does. And but even in the short time that I've been here at White Tiger Connections, I feel like when I first started, the multiple ranges that we were kind of talking about has already shifted into a slightly higher number already. And we're talking less than a year. And it's incredible to see like how whenever something new, whenever an update comes out, whenever a new piece of technology and people start to adapt and start to use that, obviously good reviews spread like wildfire. More people want to start using it, and that's really is what's driving those things up, and that's value. And again, it's never easy. We talk about it all the time. We're not expecting this to be an easy flip of the switch, but it comes back to intentionality, being willing to work with people who have the expertise in the fields, and seeing, like we always say, the forest through the trees, and that while this feels like it's a grind right now, what happens later down the line is really what we're working towards. And I feel like the people, the firms that are building to be players in the future, staying adaptable, and things like that, not letting the market decide what their future is, are really gonna have a lot of success in the future. And That's all. That's all I had for today. If there's anything else you want to throw on at the end, you let me know. But as always, we appreciate everyone listening, and we'll be back next week with another episode.
You baked a great cake, Rich. Thanks a lot, everybody, for
Yep.
watching. Take care.
Thank you for watching The Nexus Point. See you next time.